Hey everybody, welcome to Module 9. In this module, we'll be looking at basically business plans and the financial calculations that you need to work with loans and other types of investments. There's 3 sessions in this module. Session 9.1, we're going to work with financial functions to analyze loans and investments, create an amortization schedule, and calculate interest and principal payments for a loan or an investment. In 9.2, we're going to look at calculations for an income statement, interpolate and extrapolate a series of values, extrapolate, and then calculate a depreciation schedule. In 9.3, we're going to determine payback periods, calculate net present values, calculate the internal rate of return, and trace a formula error to its source. But the bottom line is, as we go forward in this, it's very similar to the loan payment we've already learned with the PMT function from the hot dog car, if you remember from Module 4. Okay, and we're just going to go along those lines and keep on expanding. Let's take a look at the overview on page 530 and 531. And we'll start on the left-hand side and go clockwise. So we have the FV function, calculates the future value of a loan or an investment. The NPER function calculates the number of payments required to repay a loan or to reach an investment goal. The payment function calculates the payment for each period required to pay a loan. We've already done that in the past. Negative cash flow or cash outflow is a negative value that represents cash going away from the investor. The PPMT function calculates the amount of loan payment applied to the principal. The IPMT function calculates the amount of a loan payment used to repay the interest. The PV function calculates the present value of a loan or investment. And positive cash flow or cash inflow is positive value that represents money coming to the investor. Okay, and first we're going to talk about borrowing costs on page 532. Okay, so let's start off this module by doing the calculation with the payment function on 532. It says that Ryan's company borrows $400,000, and that is at 5% annually. And he's going to repay it quarterly. Okay, so basically we do equals PMT. The rate is going to be 1.25% because we're calculating it annually, or we could do 5% divided by 4. Okay, we're going to have 20 payments over a 5-year period, and the total amount that we're borrowing is $400,000. And basically each quarterly payment would be $22,728 and $16. Okay, so let's look at the cash flow paragraph at the bottom of 532. What they're saying is that a positive number, see it's in black, means that we're getting 400,000 and we're going to have to repay that, right? So that's money coming in is in black, but money going out, which is in red, is a negative number. That's called the cash outflow. So this is the cash inflow, the cash outflow, and because of that, they're positive and negative values. So we know what money's coming in versus what money's going out. Okay, so let's take a look at the loan analysis example. This is from the QR document, and I did the example here on page 533, and this is exactly what we did over here. I just broke it down into the steps using the template. So we put in 5% annual interest. We're going to borrow $450,000. Future value means how much is the loan going to end up at the end of our calculation. So for example, we're borrowing $450,000. If we only have to pay back $400,000, then this would be $50,000. But right now it's 0 because we're going to pay off everything when we get to the end of the loan. We're going to borrow it for 5 years, and we're going to make 4 payments per year. The total number of payments is going to be 20, which is basically 5 times 4. Our annual interest rate is 5% that we got from over here. And our quarterly interest rate is going to be the annual interest rate divided by the number of payments per year. So we got the effective rate of 1.25%. And then finally, we want to figure out the payment formula. So we're going to type it equals PMT H7, which is our rate per quarter. Next, we're going to put in F7, which is our number of payments. And then finally B7, which is the present value where we're starting off from. We hit enter, and we see that quarterly we have to pay $25,569. And you could follow along with this file, which is in the module folder in Module 9. Okay, so in this example, this is the quarterly payment example. What we did is we took the loan, number of years, payment per year, number of overall payments, the rate that we're going to pay yearly, the rate that we're going to pay quarterly, and our quarterly payments, which are $25,000. Now in the text on page 534, it says that Ryan doesn't want to pay this much. That's way more than he thought. He was thinking more like $20,000 quarterly. How could we figure out payments like that? So to do that, we're going to use the FV calculation, which we're going to put for future value. Okay, so now we're working through the box on page 535, figure 9.2, and basically we've put in 450,000. All the payments are the same, so we have 5 years, 4 payments per year, 20 payments overall, 5%, 1.25% quarterly, but we only want to pay $20,000 a year. So now there's going to be something left over, and that's what we're going to find out here. In the top example, that leftover was 0 because we paid off the entire loan. Now we're going to almost pay off the entire loan, but since we're paying $5,500 approximately less per quarter, we're going to have a bit left over. So to figure that out, we'll type in equals FV. You'll notice that we're doing the formula this time in the future value box because we know the other variables. H8, that's going to be our rates, the same as before. F8, that's going to be our number of payments. I8, that's going to be the total amount that we end up with. And finally, B8, our total amount overall. Okay, so it's actually the same as payment function, except we have one more piece where we're calculating how much we're paying, and this will look at the difference. So it's going to say, when we're done this loan at $20,000 per quarter, at the end of 5 years, we're still going to owe $125,657 left over. Okay, so we worked this out, and our boss, Brian, is still not happy. It says in the text, because a significant amount of the original loan would still be unpaid, over $125,000. After 5 years, Ryan wants to know how much more time would be required to pay the $450,000 loan, but again, we're only assuming that we pay $20,000 a month. Essentially, at this rate, how long will it take off to pay off the rest? And we can calculate that using the NPER function, which is going to be run in this cell, and we're basically going to calculate the number of payments because we pretty much know everything else. So let's fill it in. All right, so we've gone through most of figure 9.3 on page 537. So here we're looking at the payments, right? So we know that we want to borrow $450,000. It's going to be worth 0 at the end, but the question is, we want to know how many years that's going to be, and how many payments we have to make overall. Okay, that's what we're going to figure out next. But everything else pretty much stays the same. We're going to pay $20,000 a month, and our quarterly rate is going to be 1.25%. So in payments, we're going to enter NPER, and this is going to give us the number of periods. So we're going to do H9, I9, and B9. Okay, giving us the rate, the quarterly payments amount, and the total. We're going to hit enter, and it's going to say 26.58. So basically, it's going to be 6 more quarterly payments, or a year and a half, to pay it off. And next, we're going to figure out how much that actually is in years. So we're going to go to D9, and we'll type in equals F9 divided by E9. Okay, so we're going to take the total payments divided by the number of payments a year, and that's going to give us 6.64 something years in terms of the repayment. And that all looks fantastic. We basically have an idea of how much we want to pay off based on the NPER calculation. However, as you can see at the bottom of page 537, Ryan says, I don't want to take 6 years to pay off this business loan. Basically, he says, now I'm willing to change this number, the 450,000, in order to repay it based on borrowing $20,000 a month. So we're working completely from the opposite way. Instead of knowing how much we're going to borrow, we wanted to see how much we could repay, and based on that, how much should we then borrow. Okay, so our last example is on page 537. Ryan doesn't want to take more than 6 years to repay his loan. So basically, this would be too long, right, with the 26 payments. So he suggests that we calculate the size of the loan that could be repaid within 5 years, so going back to our original, but with $20,000. So basically, we're going to take 5 years, $20,000 instead of 25, and we're going to see if we can make that work with a lesser amount. So basically, it would be similar to this one, except we would end up with 0. So basically, we would be borrowing less money. So how do we do that? With the PV function, which calculates the present value of a loan or investment. For a loan, the present value would be the current size of the loan. Okay, so that's going to help us work backwards and figure out how big should the loan be. So I'll fill in the numbers. Okay, so we copied everything over. So we have future value is going to be 0. That means at the end of the loan period, we're going to end up with nothing owing. We want to pay it back over 5 years, 4 payments per year. That's going to be 20 payments. We're going to borrow it at 5% annual interest rate, or 1.25% quarterly, and we want to pay back $20,000 per quarter. So the question is, how big is the loan? And let's find out. We're going to type in equals PV H10 for our rate, F10 for number of payments, and I10 for our quarterly payment amounts. And that means that we could borrow $351,000. If we borrow this amount and we pay it off $20,000 a month with this amount of interest quarterly, over 5 years, we'll have paid it down to 0. And compare that to if we borrow $450,000 at $20,000, we still would have another $125,000 left over at the end of the period. Okay, one last note. The text says to change the loan to minus $23,000, and that brings us to around $400,000 for the loan. So we're paying slightly more per month, but that gives us a little more at the end, about $50,000 more, to get to our goal. We could also use GoalSeek to connect these two to find out how much would we have to borrow monthly in order to get to a certain amount for the loan, as we looked at in previous modules. Okay, so now we're moving forward to 539 and 540. We set up our loan schedule, but the thing is that we have our loan, we have our annual interest rate, payments per year, our rate per period. For the quarterly, we're paying 1.525. Quarterly, we're paying 1.25%. Over 5 years, we're making 20 payments, and we're going to pay $22,728 per payment. However, we want to figure out in this schedule how much we're going to be paying in interest versus principal for each payment. So to do that, we're going to create an amortization schedule, which you can see on page 540 and 541. Okay, so we enter this formula, step 2 on page 541, to calculate the interest due from the first payment. So basically, we are taking the rate, which is 1.25%, B9, which is the period. So in this case, it's per the 1 period. We have 4 quarterly periods, and you can see here this is year 1 divided into 4 periods, year 2 divided into 4 periods. Next, we have our number of payments, and finally, type, which is present value, which is how much the entire thing is worth that we're working off to at the end. Okay, so we hit enter. That's going to give us negative 5,000, and it's really important. The number one thing that people get confused is that each one of these terms has to be in the same time reference. So they all have to be monthly or quarterly or annually. It just depends. And if they're not, then you need to divide the ones or multiply the ones that are not to make them all equal the same when you add them up. Okay, and step number 3, we go through and we want to look at how much principal is going to be paid off in this one payment. Remember that we're paying $22,728 per payment. In this one, $5,000 is going to interest, and the rest is going to go to the principal. So let's take a look at what we have. We have the rate, which is our 1.25%. our one period that we have. Next, we have the number of payments overall. And finally, the total value of the loan. Let's hit enter. And using the PPMT function, we come up with 17,028. And then finally, let's add these two together. So close that almost worked. Let's just put in addition. There we go. So we could see that this 22,728 is equal to this one, which means that we're paying the right amount per period. And again, money coming in, the money that we get is 400,000, and all the money going out is a negative number, and that's going to be in red, or in this case in brackets. It could also have a negative sign depending on if we are in currency formula or number formula or accounting formula. You'll notice that currency here has the minus 5,000. This has minus 5,000, no dollar sign, and this just has the 5,000 in brackets. Okay, let's move on. All right, so I filled out the rest of the table according to figure 9.6, the box in the amortization schedule on page 542. And I'll just show you a couple interesting things. So first, I had all these numbers that I auto-filled. Okay, so I just grabbed the row once I put the formulas in, dragged it down, and you'll notice that when I drag it down, I have this box here, and I can click Fill Without Formatting. And that will basically maintain formatting. We've had some issues before where it deleted lines and so on, but if I want to keep them the same, this is a good way to do that. I could also do that from here. The numbers will stay the same, but it will add the dollar signs. But you see these black lines that normally got erased? If I want to put them back, I just press Fill Without Formatting, and it will preserve the format of the sheet, but it won't delete the values behind it. Finally, I just take C28, which is our principal remaining, plus E28. Now I have to do plus because this is a negative number, and I hit enter and I get 0. So the two cancel each other out, and my final payment for month 20, which is in year, payment 20, which is in year 5, I end up with a 0 balance. Okay, so the last part of the module on page 544 and 545 is to figure out how much we're spending in interest and principal, not on a quarterly basis, which this gives us by payment, but on a yearly basis. So here we have, we use cumulative interest, and we use the cumulative payment principal in order to find out how much we spend each year and how much principal is remaining. So in year 1, we spent $18,659 on interest versus $72,253 on principal. And we still have, from the money that we borrowed, $327,747 left over in our principal. Let's look at year 5 in comparison. So in year 5, we have we paid overall $2,772 in interest, and we paid $88,141 in principal, and that brings us down to 0. Our total principal payment is $400,000, and our interest that we're going to pay overall is $54,563, and this will show us our principal declining as we go forward with the loan. And that brings us to the end of 9.1. Also take a look at the Pro Skills on page 546, which will give you some helpful hints on how to put together a financial statement. For the next sheet, for the next module, we're going to take a look at income statements and depreciation in session 9.2. Thanks.